One of my favorite ways to invest ever, and I would go even as far as to say that this is the best, safest and easiest place to invest long term for most people. This is an investment strategy that requires very little work, no skill needed, and still has one of the best returns out there. And to make it more interesting, what if I told you that this investment outperforms 99% of individual investors and 95% of hedge funds out there? And this is something that you could do with about 30 minutes of your time to profit long term and one day reap the benefits of it. What investment am I speaking about? An index fund, of course. An index fund is a type of mutual fund or exchange traded fund, or better known as an ETF, which tracks the components of a financial market index, such as the S&P 500 index, which tracks the top 500 companies in the United States. To better understand this, try imagining this. Instead of spending $5,000 to buy one property entirely, imagine you invest into 500 different properties for $5,000 spread across different parts of the world. Then you would own 0.1% of each of the top 500 properties, which is a great way to diversify your investment. So instead of owning a small portion of 500 properties, you would basically have a small ownership of all the top 500 companies in the United States, which is what the S&P 500 index fund is. Now, the S&P 500 is just one of many funds out there. Each index fund contains a pre-selected collection of hundreds or thousands of stocks, bonds, or sometimes both. If a single stock or bond in the collection is performing poorly, there's a good chance that another is performing well, which helps minimize your losses. On the other hand, when you buy an individual stock such as Apple or GameStop, if one goes south, your savings will take a much bigger hit in a short period of time. The biggest advantage with index funds is that the fees are extremely low. This is because there's not much work for a company such as Vanguard to maintain these funds. You can pay as low as a 0.05% fee. This is the total opposite of a mutual fund where a fund manager is assigned and his or her job is to beat the market, which rarely ever happens. These fees generally can go up to 2.5%, which is astronomically high. Now, you may think that there's not much difference between a 0.05% and a 2.5% fee, but over 2 or 3 decades, these funds' profits will be massively different. Most investors would make much more money in an index fund than investing into individual stocks on their own. Several studies have shown that over 95% of portfolio managers cannot outperform the market index in a 10 to 15 year period. And these are some of the brightest people from around the world who were in Ivy League schools, who have a deep understanding of the economics behind it and are doing this all day, every day, and are still unable to beat the market. These figures are much worse for the average investors, as the average investors tend to trade emotionally or panic when the market drops, or they try to time the market. Warren Buffett claims that almost all funds managed by fund managers, the clients are not seeing much of the profits, but the fund managers are. And this is because of the high fees that they charge. Buffett also claimed that index funds are the best form of investment for 99% of people. The world's richest investor is outright stating that we should go out to buy index funds, then this is probably something we should be listening to. The second advantage to owning index funds is that you don't have to do anything. This investment of yours can be fully automated. All you need to do is set up a monthly automated deposit into a certain index fund and leave it there for years. If you really feel you want to monitor your performance, then what I do is I browse through my index fund investment every quarter and monitor its performance. Many companies outright show you the percentage in profit, so all you need to do is log on and see that number. And the final big advantage is your risk. By investing into the S&P 500, you are massively diversifying your investment, which is having stocks collectively in 500 different companies rather than just one. If one of them goes down, it's not a big deal, as you have 499 others to ensure your investment still stays safe. In terms of which index funds to invest into, I would suggest investing in 3 index funds that gives you a diversification from all around the world. Number 1, I would first invest into an index fund that tracks the top 500 companies in the United States. This would basically mean investing into an index fund that tracks the S&P 500. Vanguard's VOO is the fund you want to invest into for this, which has a return of over 420% since inception. The minimum you need to invest into this is just $1 and it costs next to nothing in fees. Secondly, invest in an index fund which tracks all the stocks within the United States, which is Vanguard's VT-SAX, which has a return of over 350% since the year 2000. And lastly, I would recommend investing into a bond. Reason for this is bonds are generally considered the safest investment as it does not typically have a dip in the value of index funds during a recession. Though I would recommend this to be the smallest portion of your investment, especially if you are under 40 years old. As you get closer to retirement, you want to shift from other index funds into this one because bonds are less prone to recessions. Note that some countries don't have bonds as investments but would have a fixed deposit style of investment, which has some similarities. The biggest one being that both bonds and fixed deposits are considered a safe investment. The biggest one being that both bonds and fixed deposits are not affected by recessions and are considered an extremely safe investment. Now, I promise this video is not sponsored by Vanguard. However, I continue to bring them up as I know they are a reputable company. So when investing into index funds, Vanguard is just one example of companies that has index funds which tracks something like the S&P 500. But unfortunately, Vanguard is only available in certain countries such as the United States, United Kingdom, Canada, and Australia. Countries like India, New Zealand, and South Africa, for example, are not able to invest into Vanguard. However, that does not mean you cannot invest into index funds, as countries that do not have Vanguard, they have their own companies which will allow you to invest into index funds. For example, in South Africa, Satrix can be used to invest into an index fund. Now, investing money into these different types of funds would depend on your risk appetite and your age. Now, how you would want to proportionate your money based on the above three mentioned index funds is generally if you are younger, let's say from the ages of 18 to 40, you want to invest a bit more aggressively. This would mean investing a larger portion of your savings of, let's say, around 80% into the S&P 500 index, as these are slightly more risky investments in the short term, which means if they had to fall in value in 2 or 3 years at times during a recession, it will recover with more gains within 5 to 10 years. Your remaining 20% I would put into bonds or fixed deposits. If you are closer to retirement, it would make more sense for you to invest a larger portion of your savings into a safer investment such as bonds and a smaller percentage into index funds. I would like to be clear that this strategy makes sense for most people, which will bring in a great return for the next 15 years on average. Yes, there will be certain people who invested into Apple or Amazon who have seen significant returns. However, they have invested a lot of money into these companies with the risk that those stocks could plummet and reduce in value and lose their money in a very short period of time. As just like how some people have made a lot of money investing into one stock, more people have lost tons of money by investing into single stocks. Warren Buffett states that trying to time the market is a mistake for almost all people. I've met countless amount of people who have not invested into index funds because they believe that the market is at a peak. The truth is, no one can accurately and consistently time the market. No one could have predicted the pandemic and the effects it had on the markets in 2020. You may have thought that in 2015 the markets has reached its peak, when in fact the bull run continued for another 7 years before falling slightly during the pandemic but making a swift recovery. There have been multiple studies done which proves over and over again that time in the market, not timing the market, is what builds wealth. If you feel putting a large sum of money at once is a little too daunting for you, most index funds allow you to put in monthly increments of your savings, which can ease any concerns that you may have. The 3 key things to remember from this video with regards to investing into any index fund is ensuring that the company you are investing is reputable, such as Vanguard. And number 2, ensuring that the fees you are paying into the index funds are less than 0.5%. And finally, ensuring that you have a look at the track record of the index fund for the past 5 to 10 years, and that is at least returning on average around 10% per year, or just stick with investing into the S&P 500. I hope you have enjoyed this video and have learned something from it, and if you have, then please consider liking the video and subscribing. See you guys in the next video.